Hello, my name is Afsaneh Beschloss. I'm founder and CEO of RockCreek, and I'm delighted to be here with Dr. Alan Greenspan and with Dr. Liaquat Ahamed today to talk about what is going on in the markets. And happy birthday, Alan.
Thank you.
I was curious to know, Alan, starting with you, what you think is going on and how much more pain are we going to see looking forward into the economies and the markets?
I'm glad you asked the simple questions first. I think the best way to look at this is that the virus is essentially a triggering mechanism, and it obviously creates major uncertainty. And it's the uncertainty of what the virus is engendering that's creating market chaos. But the fact that it's limited is a critical issue in market evaluations, because then we go back to what we're used to dealing with, and the book will close on this, but not right away. If we're worried that our capacity to worry is not being employed, forget it.
I completely agree with Alan. I suspect there are a couple of more shoes to fall. Whenever markets move very quickly, someone was on the wrong side, and I would suspect that we will have a couple of major financial crises type events before it's all over. And I think you can see that. You can see some of that in the way the bond market's moving. That there's this dramatic flight to safety. The Fed acted very aggressively.
Have we seen this kind of rates?
Well, we've never seen these kinds of rates. We've seen shocks.
Right. But are the rates telling you something different?
Well, the rates are telling you that we're going to get a recession and the Fed is going to zero, right?
And what that has meant is that, we have the 30-year Treasury bond. 30-year Treasury bond was yielding a reasonably high percentage. And then all of a sudden, it broke down on the downside. And I suspect, but cannot prove obviously, that a goodly part of this is the basis of people who are recognizing increasingly that they need annuities out there. Annuities of a AAA quality. People who own gold almost invariably have a cost of holding it, which is the storage or something of that sort, and its yield is zero. And so it's got a negative yield.
Right.
And I always find that, substituting the Swiss franc for gold or things like that gives you kind of, it lends the notion of what it is that's happening in the negative interest rate area. Everybody's going berserk. We've been living with one for generations. The price of gold adjusted per unit of goods and services is almost flat, going back to the beginnings of the gold standard.
Alan's point that for safe assets, that you have to actually pay money historically for the safest asset, and that you don't get it for free, is spot on. And the safe asset used to be gold, now it's treasury bonds, and as a consequence, it's not out of the bounds of all thinking to believe that negative interest rates are going to be with us for a while.
So a while meaning years?
10 years.
It's when the perceived market value of the cumulative coupons plus the repayment at maturity, that is what the number is that you start with, and that will lead you under certain conditions with a negative interest rate.